Good morning, folks. I'll be checking Twitter for a 5x5 if the audio is good, if the volume is good, and you can see my weekly dollar index chart. As soon as I get someone to confirm that that's good, I'll begin. Thank you, Swissman. Thank you, William. All right, so we are looking at a screen that I don't need yet. Hold on one second. Okay. All right, so this is going to be brief because I want to get back to watching live charts with my youngest son here. So the weekly chart, as you may have recalled if your notes are being maintained well, during the month of August, we were looking for price to run above the buy side here on the daily chart. We'll drop down to that in a moment. Then this buy side, and eventually would draw here. And I said if we got animated above this level here, our attention should be focused on this inefficiency here. So in your charts, you should have this highlighted, drawn out into the future, and then here is buy side. And this is all weekly level, so it's very, very high time frame. It's very well, it's going to take a little bit of time to get to these types of levels. So whenever I'm referring to weekly targets like this, invariably someone that's new or someone that isn't really interested in trying to learn, they just want to take something out of context, they'll say, I'm expecting that level to happen that very moment or that trading day. And it's not that way at all. It's just to keep you focused on where my mind is, the internal dialogue as I'm watching price each day, each session, each time I watch price present a setup. I can trade against this, and you can once you get better versed in reading price action. But in the beginning, it should be something that you submit to as you only look for setups in these long-term directional draws on liquidity. That's the kind of like the primary function of how I teach in the beginning. It takes a little bit of time to get warmed up to the idea because, especially if you're looking at lower time frame charts, and we'll drop down to the daily now, it's easy to get lulled into thinking that that might not be where price is going, or maybe you watch me do something, or some of my students, or someone else entirely different, that doesn't trade like I teach. The idea of wanting to do something right now that may be opposed to these longer term draws on liquidity may get you into trouble, may hurt you, and then regret, remorse, and then you'll feel the pain and agony of knowing that you did something that I've told you many times in long drawn out woodshed moments in these videos and in the Twitter spaces, which is primarily trade psychology, that type of thing. It's better hearing it versus me trying to type it up into a book. When you hear someone kind of like beat it in your head to focus on these things, don't focus so much on these other things and how you're supposed to be navigating these problem areas and how to discover what they are, not to be afraid of them, but to tackle them. That's what the Twitter spaces are for, and they're raw. Sometimes they're not used, with language that's so eloquent, but I don't promise eloquence. The idea of drawing towards the low end of that weekly sell side imbalance, buy side inefficiency, which is here. Remember, on the weekly chart, this is one single down closed candle, but now it's two. Buy side resides just above here on the week of November 21st, 2022. So that high comes in at 107.993. So we'll just call 108 as the long-term buy side liquidity. We have a smaller one here with this high, comes in at 107.195, which is essentially in agreement with, if it takes this high here on November 30th, the week of November 30th, we take that high, chances are it's going to run and touch the bottom of that weekly sell side imbalance, buy side inefficiency. So these are the levels you should have on your chart from the higher time frame, weekly and daily. And we'll drop into a Euro chart real quick. Satisfy the old FX group. All right, so I hate when it does this. Drop back up into a weekly. All right, so we've been watching the euro and cable and dollar. And I know some of you want me to drop into these lower time frame charts because you want to pass your funded account challenges and stuff. But I've been telling you where the market's been going on the daily chart and the weekly chart. And it might be one of those things where you can see it now panning out like I outlined, and you're regretting that you didn't do something with the information and or worked with this as your bias looking for setups. Don't beat yourself up. Don't vent on social media to me about why you didn't listen or anything like that. That's the worst thing to do. Don't complain in your little circles on Discord or Telegram channels or other, Twitter communities or whatever. By doing that, you're reinforcing bad habits and you're reinforcing toxic thinking. Versus if you didn't do anything with this information, if you weren't looking for shorts like we were outlining, that would be the best case scenario because dollar's bullish, euros should be bearish, the pound dollar should be bearish. There was news last night, by the way, for Aussie dollar. I completely forgot to mention it. I don't usually bring it up, but I'm going to look at that one next. But without having looked, I don't know, but Aussie dollar should have went lower. I don't know if it did, but I know it had some news like in the evening time, my local time. So I'll take a look at that in a moment. But we're going to go through euro first, then pound dollar, then Aussie dollar. I'll look at gold real quick, and then we'll go into the index futures, and then I'll wrap it up because I got to get busy with my youngest son here. So anyway, we were looking at this draw on liquidity here. I mentioned how this inefficiency would act as an inversion fair value gap. That's not noted now, but go back and don't take my word for anything I'm saying here. Go back and look at the analysis that I gave in Twitter Spaces, talking about it in the live streams that I've talked about these things, in the video commentaries that I've posted. Incidentally, I also have this in my notes here. I saw a tweet. Someone mentioned that there was, oh, not a tweet, I'm sorry. I get a lot of comments in my videos, and somebody mentioned a link to me that is a YouTube video for my 2023 playlist, but I was unable to put it in the playlist. I don't know how I messed that up, but if you're listening or if you know that there should be a video that's not in the 2023 mentorship playlist, send that link to me on Twitter so that way I can make sure it's in the playlist. I appreciate that. But we were looking for lower prices, draw on liquidity here, and I said if we get animated below this, we will be moving over to these lows here. So the first one's here, and that's what we're having highlighted with this weekly candle on the week of March 13th, 2023. That low comes in at 103.16 and 2 pipettes. So we'll be expecting the price to draw eventually down into that. I'm not saying that it's going to happen today. It could happen sometime the rest of this week. It just gives you a framework to aim for. So that way you're not getting caught up in the excitement of lower time frame charts and completely forgetting that this is where the likely algorithm is pulling price to. We'll drop down to the daily chart real quick. And no, I'm not dropping any lower than the daily chart. You don't need that. Yes, we do, ICT. You're holding it back. All right, so there is where I believe we're going to draw to. It's enough to get something out of it. Should it give you another opportunity today or going into the Friday? But we talked about this level here and consequent encroachment. Look at the bodies. Go back and listen to all that jawboning session. We tanked here, create another sell side imbalance, buy side inefficiency on this candle here on the September 5th. So we traded up into that. That right there is a swing trade for those of you that don't have the ability to sit and watch day trades. You don't want to trade 5-minute chart. You don't want to trade, anything less than a daily time frame. because you have a work schedule, or you're just a working class hero, you're running a business, you're in school, you have to sleep. Your life doesn't allow you to do these types of lower intraday setups. The formations in price action on the daily chart are doing the same things that you see me and my students trading with 1-minute charts and 30-second charts and 15-second charts and 5-second charts and 1-second charts. Price is fractal, meaning that everything that I use to get into a time frame of any market is applicable for any time frame that you can use that fits your specific model. If these lower time frame charts are moving too fast, and I say that in a manner that is tongue-in-cheek, meaning that they're not going any faster than the daily charts moving. See, you're afraid, you're building this fear that these markets are moving supersonic in the lower time frames when they're moving at the same exact pace. The problem is you're over leveraging many times on these lower time frames versus just simply doing the least in terms of leverage and using the experience that multiple time frame entries on lower time frame charts can provide you. It gives you lots of opportunity to practice or backtest, but never losing sight of these higher time frame charts, because this is where the real draw by institutional investors, traders, large firms. They're doing their analysis on the weekly and daily. That's why I've been talking to you in these time frames, because your mindset needs to be anchored on these time frames predominantly, and then using the information that's derived from these time frames, then engaging in being a mechanic with price action in the lower time frame charts with this logic in mind. If you do those types of things, your win rate will increase. You will still suffer losing trades. I'm not trying to promote the idea that you can trade perfectly. I take losses. You've seen them. You've seen me take them. You've seen me work out of them. You've seen me reverse on them after being stopped out. Even being right or wrong, it doesn't change the model. It doesn't remove the efficacy of it. It just makes the reality of making and losing money what it is. And if you have your logic as to what you're aiming for, what you're trying to frame the trades on, not for pattern's sake, okay, not for team mentality sake, meaning, supply and demand, Elliott wave, Wyckoff, whatever. And by the way, Steve Morrow, I didn't copy that stuff from him. All his stuff is from my 1996 notes, so stop leaving comments in my video channel. Steve Morrow is welcome to come out here and do whatever he thinks he can do live, and I'll work circles around him too. Yes, that was an ego moment, and that's me beating my chest. He's a student. That's the way it is. This right here, that inefficiency trading right into that is a swing setup. That's a swing trade. And what would you be aiming for? You'd be aiming for the run below that low here. In longer term, you would leave your stop loss above this high. This is what makes long-term swing trading very difficult, because you have to allow the market to go into profit and then be willing to see it go back against you. So as a long-term swing trader, for those that are listening, if you want to have some notes on this, I'll talk more about it in my books, and you can go back and look at my YouTube core content lessons around swing trading. In swing trading, you want to try to build in a position slow. And when it gets to a higher time frame discount, if you're short, like we're seeing here, this is where you would take some of the short off, waiting for it to potentially give you another reversal so you can add it back. And that would be inside of this area right in here. There's your fair value gap. And inside that fair value gap, your stop would be above here, never moving it. You cannot move it. You have to leave it there. And it's scary. That's why swing trading, you think that you're avoiding risk by not trying to get in these lower time frame charts, when that's the best place for you to learn, because it'll teach you stop place management. It'll teach you patience. It'll teach you no fear of running out of setups. It'll teach you that your model works. It'll give you more in the trenches experience of reading price real time than any other time frame. But in swing trading, if you're trading with a daily chart, you cannot make a move of moving that stop loss to break even, trailing it to lock in a profitable exit. All you're doing is ensuring that you're going to get stopped out prematurely before your objective is met, because there's a lot of give and take on a daily time frame. Unless that you have timed your entry, which you're not going to do this in the beginning. It's going to take you years. Okay, so when you hear me talk about it's going to take you years to get good at this, getting good at it is not profitable. I've already said that you could be profitable rather quickly if you do the right things and study the right way. But to be very good at it, where you can time the very explosive type of price action runs that start right from when you try to get in at, that takes years of getting experience to do that. So in the beginning, you have to give yourself the permission and the time to build up your experience. So that way you're not holding yourself to a level of expectation that's unrealistic or unreasonable. And then when you don't hit it, you start doing things recklessly, over trading, over leveraging, trading outside of your model because you're impulsive. You just want to fix the mistake you just made. You want to get back that loss that you just took. You want to fix the drawdown. All these types of things. That's how it creeps into your trading. So on swing trading, in this instance here, if you were watching price, you would see this fair value gap here on the week of September 5th. Knowing that it trades up into that, that's a setup. You can get short there. As a trader that doesn't use intraday price action, the way you would do this is on this. Let me see if I can zoom in. I apologize. It should have been zoomed in a little bit more. Okay, here. Now, also trading on a daily chart like this, that means your leverage is going to be extremely low. I know you want to trade with whatever the maximum these funded account challenges and firm companies will offer you, but you got to stop thinking like that. Okay, you got to stop thinking like that, because if you've been watching my son, his Top Step Express funded account, I think I said that correctly. If I didn't, I apologize. He's only trading one contract, and now he's being offered the ability to trade with 5. He won't be trading with 5. If he's going to stay out of the woodshed with me, he's just going to do one contract through the duration until he gets to $10,000, and then he's done. Trading with a daily chart, you want to trade with the leverage, lowest leverage, that'll allow you and to afford you the ability to trade with a idea of selling. Listen now, you're going to sell weakness as a swing trader. If you can't watch intraday price action, that means you absolutely must, one of two things, either get up during the day and look at London and wait for a run that would be, in other words, in this area here when it was trading up into this price point here. Now, I know some of you may be watching this for the first time. This is all hindsight. This is all hindsight. No, it's not. We talked about these things before it even happened. We talked about the price being here. We talked about the price going down here, and it's happening on your daily charts. I'm not bending time and space. I'm literally telling you the future using the concepts that I've laid in your hands for free. But you have to do one of two things. You have to get up on the day that you want to try to enter on your swing trade, which would be here, here, or here, any one of those days. And you have to allow for a stop loss that's above this high right there, because you're swing trading. And you would sell a run below this day's, and we're on the daily chart, yeah, make sure, September 12th, whatever that opening price is. You can use the settlement price here on TradingView. You can use, in my opinion, I would be using the midnight opening price in New York local time. If it trades below that, you'd be selling short. You would sell weakness as it breaks away from that inefficiency and goes below this candle's low. So your trading wouldn't really begin until this day here, because the open on this candle is down here, which makes no sense, right? Because you're too far away from the fair value gap. This is the first day that sets you up as a non-intraday, non-minute, second, 15-minute, 1 hour, 4 hour, anything less than a daily chart you can't enter on, because your life is what it is, and there's no shame in that. It doesn't mean that you can't make money. It just means that you're going to trade with a whole lot more patience required, a whole lot less leverage, and your stop losses are going to be absolutely enormous compared to what you see me using. Are you willing to compromise? If it's all about making money and making ends meet and moving towards a better lifestyle through another source of income that's potentially available to you but not guaranteed to anyone, then that means that it won't matter that this is the way you're going to have to do it. But the logic is still the same, because if this was a 5-minute chart, or if this is a 15-second chart and this was the fair value gap, I would tell you that the stop loss needs to be above here anyway, because this is the candle that makes what? The inefficiency. So your stop loss has to be above here. Well, I can't trade that way. Okay, trade something else. Don't use my logic. Go out there and lose money. Go do whatever you want to do. But if you're asking me how to teach it to you and how it should be done, that's not in an intraday capacity, this is what you're going to do. Because all you need to know is whatever this opening price is here, or whatever the opening price is at midnight that day, and the next trading day here, wait until after 9 p.m. the next day. Why? Because now you have Asian session in place. If it trades below that, you're short. Your stop goes above here. Whatever the leverage is required to allow you to do that and not risk more than whatever you're comfortable with, never more than 1%. That's a big stop loss, blah, blah, blah. But this is a big run down here. Think. You have to start somewhere. And if you can't start in the intraday charts, and you can only operate in this until you make life changes, because you may have to do life. If you want to be a trader, if you really want to be a trader, and you can find your way of making consistently accurate setups, even in this manner, you will make changes to allow you to trade in the lower time frame charts. Guaranteed. No one's going to say, no, I don't want to make $1,000 a day when I'm stuck making $2,000 over the course of 8 weeks, 4 weeks, or whatever it is. Believe me, money talks, bullshit walks. You will absolutely make changes in your life. You'll convince your spouse when they start seeing the money. That's the way it works. Nobody's going to believe you in the beginning. But when you start showing the receipts and the money, they're all of a sudden they're interested in what you have to say about it. But in the beginning, you don't have that. So you have to keep quiet about what you're doing. Don't tell your left hand what your right hand's doing. But once this setup here forms, in this day here, you'd be selling short on weakness. Guess what that means? That means you can sell short on a stop. That means you're putting a stop loss that would put you in the trade. It's not stopping you out with a loss. It's a sell stop at this candle's or that day's opening price, preferably midnight. I use midnight New York local time. I like that. So as long as price on the next day was above it here, who cares? You're not interested in that. And you're sleeping. You're at work. You're at school. You're doing whatever. At some point, it's going to trade below that level here, and that stop order will become a market order to sell short. And then your open order for shorts needs to be protected with a stop loss above here. This would be a first partial. You can put multiple trades on, folks. Some of you are thinking, oh, I can't do size. I can do, you're right. You can't put a lot of size on it, but you can put something on here where you can take a partial off. Down here, you take off one of them. Then, because we see this big run down into this low, it creates a potential inefficiency, which is confirmed when this candle right here on the September 5th, once it closes that high between this candle's high right here, that candle's high, and that candle's low, we have an inefficiency. So you can take and add inside this inefficiency whatever you took off as a partial down here, you can add it back when it trades up into here. But look at this heat right here, ICT. It doesn't matter. You're anchored with your core entry up here. And your stop still remains right there. Can you swing trade with that logic? Because if you can't, then swing trading is not going to work for you. I'm just going to save you a whole lot of time. That is how it is. If you do anything apart from that, you're going to get stopped out a lot. You're going to take more losing trades. You're going to have a lot of failed launches with your setups, and you're going to be really impatient. And all of those things are going to coalesce into a tapestry that will keep you from being profitable, and it'll just make you want to quit. You'll either want to do something else, or you'll want to do nothing at all with the marketplace. And that's the reality. I'm not trying to sugarcoat it for any of you. That's just the way it is, and there it is. But you can add it back here, and then once we break below here, you can take another partial, or Between this low and the next level down here, that would be, again, that weekly level here. Between this low and this low, where do you take partials at ICT? Whenever I see two targets like this, I'd like to take that and divide it into quarters. That's not quarters theory. Okay? Stop telling people in your comment section or trying to comment in mine nonsense saying I'm teaching quarters theory. Quarters theory is absolutely nothing to do with what I'm doing. I'm projecting an implied dealing range. That means I'm anticipating that this low will break and reach down here. For the people that just watched this for the first time, go back and look at what's already on this YouTube channel. I already said price was going down here. A month and a half ago, I told you this is where it's going. That's not bragging. I'm reminding folks that take things out of context because they don't take notes, they don't listen, and they want to have selective hearing. We have not been bullish on euro. We have not been bullish on cable, pound dollar. We've been bullish on dollar. We've been bearish on indices after it ran a specific high. When we get to that, I'll talk to that about as well. But in this low and this low here, if you take your fib, see, I don't use fib like everybody else. Okay, and these guys that run around with this retail logic like to come around and say ICT doesn't use a fib. But I'm getting the daily highs and lows in my trades. Are you? All right, so here is, let me put this back up here because I know some of you like to ask me all the time. What's your fib settings? Take a screenshot of that. Again, as a reminder, I changed these two here. If I want to do like TGIF measurements, I'll do the 25, I'll change that to 0.20 because that'll give me the 20% and the 30% is this one here. So I use these two boxes here for TGIF, but I have to change the 25 to 20. So it's 20% to 30% of the weekly range, which is TGIF, a retracement idea. And you can watch the video I made on that on this YouTube channel. It's all there for free. So, and the rest of these are all just the standard deviations that I use. So with that in mind, between this low here and this low down here, this, as price is up here, if it breaks this low, go back and listen to it, folks. I say these things. Then if it gets animated, that means it's going to really start to move lower. Then this is where you're going to be looking for. And overall, down here, if it gets overzealous. Those were my words, verbatim. If this is an implied dealing range, it means the price hasn't been there yet. It hasn't gone down there yet. So I'm implying that the price can reach down there. That's what my analysis is suggesting to the viewers that watch my commentary. So if that's the case, then where can I take partials? If I have enough to take a partial, and full disclosure, I have not been trading Forex for years. I've been predominantly only in index futures. Why are you doing it, ICT? Because I think we're going to see a black swan event and there's going to be a decoupling, and I think there's going to be a crash that's going to happen really fast, and I don't want to be in there. So there you go. For disclaimer sake and risk, now you know why I'm not trading Forex. So that's why you don't want to be over leveraging as well. So from this low to that low here, I've broken that up into 4 equal parts, which is a wonderful area to take what? A partial here if it reaches it, partial if it goes halfway, another partial here. So right now, you should be about 75% booked in profit from anything that you've been short from up here when we were up here. How many handles? I mean, handles. How many pips is that? Lost track of what we're talking about here. It's a lot, isn't it? It's 400 plus. 400 handles. We're not talking about little micro moves, okay? We're not talking about ticks and little pipette moves, over leveraging with 40 contracts and losing on your live stream in front of everybody. We're talking about real significant price moves. Even if you have to go through a whole lot of acrobatics and have wide stops, if you can catch 250, 300 handle runs, those things add up over the course of whatever amount of time is required for you to decide if it's worth it for you to invest more time, more money, more life-changing decisions where you have to change what you're doing. Maybe it requires you to stop working the job that you're working if you want to pursue this. It may require you to change your student schedule to take classes on days that at least make it available for you to start trading once or twice a week with intraday price data. I'm not suggesting or trying to convince any of you to be a day trader. I'm just saying that these are some of the things you have to weigh out if you're going to be a speculator in these markets, because in the beginning, everybody has their limitations. And over time, you're going to have to determine whether or not if it's worth it for you to make significant changes. And if you have a spouse or a significant other, they're not going to understand it. So you have to at least have something to come to the discussion table and say, here's what I've been able to do with just this. Do you believe it's worthwhile for us to make an attempt to try to make some life changes? It may be uncomfortable. It may require you to make less money doing whatever you're doing to be able to pursue this. If this is what your heart's in, if you want to be a trader, you your results will dictate the pace at which and the timing when you want to make those changes, if at all. Obviously, if you can't prove that you can be successful with the content, whether it be mine or someone else's, then it goes without saying that you got to stay where you're at and just, keep the bills getting paid. So, long story short, we're looking for lower prices down here into here, and if it blow off move occurs down here. Okay, so this low there at 104.82. So there you go. That's what we're looking at for euro. Let's go back up to a weekly chart. If you like what I'm talking about, this is tickling your ears, giving you everything you've been looking for, seeing the future being foretold beforehand, weeks and months before it happens. Take a second and give this live stream a thumbs up. I take that as a thank you. It costs you nothing. It's nothing coming out of your pocket. I promise it won't hurt your ego and pride. You'll be thankful that you've learned it. So we're on a weekly chart, and now I want to see GBP USD. I always use Forex.com's data. And pound has a lot of distance before it gets down to the sell side. So I favor the pound because euros already done a whole lot of movement. If we see a acceleration to the dollar rallying, I think that we'll see very large down close candles, large range expansion days on cable, and we would be looking for this low down here. There really isn't any inefficiency apart from what we're trading in right now. And I'll show you what I mean by that. Right here to here. If you have not put that on your chart, it should be on there now. That's where we're trading at. Now, because we're in a deep discount relative to the high of here and the low down here, this is where price is trading at present. Look at this range right here. Say this right here. This is a balanced price range. All of this in here, I'm going to highlight it so that we can see exactly what I'm referring to. From here to here, all of this price action, that is a balanced price range because price has been offered up and down, and then it left it. Where is price trading essentially at right now? Half of this range, right? Because it's a range that has bodies, it's not inefficient. So in an inefficient range, which is a gap or inefficiency, the midpoint is consequent encroachment. Whenever there is a range that has the bodies that are laid across the entire range, whether it be an order block or a trading range like this, its range is balanced. So a midpoint of that is equilibrium. So we would measure it like this. Low to high. And we're just almost touching what would be equilibrium there. And we're inside of this fair value gap. So what does that mean? What do we do with that information? Let me take this. I don't want these settings on right now. We can see it potentially bounce. I'm not saying it's going to go here all the way up to here, but because we traded into this inefficiency, there hasn't been an inefficiency at all in here. See that? There's no inefficiency in any of that. This is the only one that exists in the price run from this low all the way up to here. This is the only one, and we're trading in it right now. So we could see it pause, pull back up into this inefficiency. I'd like to see if it does trade up into this one here, between this candle's low and this weekly high. If it were to trade up into that, I would like to see some of that stay open. So if it, for whatever reason, starts to trade higher, going into the end of the week or going into the next week, I would like to see this portion stay open. Let me highlight it for you. Be careful because this week is still trading, and this high could be taken out if it wants to retrace from the time I'm talking right now to Friday's close. So the high that's being highlighted to make the low of this gap could change, but you're always watching price, so you have to be aware of all that. But I'd like to see at least half of it, which would be right here. So I'll eyeball it. Like this portion of it there. I would not want to see price trade up into that on a closing basis on any daily chart at all. If it does that and stays open like this, my mindset is we're going down here. We're going down this that level down here. So longer term, as I mentioned, a month ago, that my mindset was the quarterly shift was bearish. We wanted to see higher prices for dollar, which is what? Risk off. Risk off means that equities, stocks, gold, index futures, and Forex will go where? Down. You have to have this in the beginning if you're brand new, if you don't know what you're doing, if you don't know how to find bias, if you don't know what you're doing in terms of picking a direction that makes sense for your trades that has the highest degree of probability behind it on a higher time frame. It doesn't guarantee that you're going to be profitable in every single trade just because you're trading this macro in mind. Macro in the sense that it's the macro time frame, not a macro that's a time-oriented script algorithmically. That's not what I'm referring to. But you have to submit yourself to an idea that is larger than the time frame you're trading. Because if you do that, you're using a time element in your trading that it's rooted in and founded on a larger time frame bias that large institutions are actually going to promote, being the weekly and the daily chart. Large firms, large lending institutions, banks, their interests in the marketplace are not looking at time frames that we do lots of entries and exits on. They're looking at weekly, monthly, and daily time frames because that's where the pools of liquidity are going to be located. That's where the inefficiencies are going to be located, which is the reason why I'm teaching you this year to focus just on these two time frames. Even though you're kicking and screaming, wanting me to go down to the lower time frames to show you these Forex pairs, you don't need that. Just use what I'm teaching you with the index futures because it's the same thing that I'm applying to that market. You're going to do the same things on these currency pairs. It's the same thing, folks. Price is going to go up for buy side liquidity, or it's going to go up to trade into and reprice to in an inefficiency. Price is either going to drop down for sell stop or sell side liquidity, or it's going down to reprice to an inefficiency below price action. That's the only two functions that price does. Anything apart from that is going to be either consolidation, waiting for sentiment to build up, and then markets will run to where the majority of the liquidity would be. So it's advantageous for smart money to pair with them. It's all rigged. It's all premeditated. It's all designed. Anything apart from those three things is manual intervention. That means that's the real underlying risk. That means that no one knows what's going to happen at that moment. You have a black swan event, an unexpected price reaction. I'll say it with my tongue in cheek. When a news event comes in or market driver releases data, and it should cause the dollar to go down, but the dollar goes up like full force. That's manual intervention. But they'll always, after the fact, say it was, they discounted, there was already price in the move. But they didn't say that beforehand. They're always going to have something to say after the fact to keep you from seeing that these markets are absolutely 100% controlled. They're rigged. Countries will not put their existence and their
financial stability in the hands of speculators. Okay, I'm sorry. I know George Soros gets blamed for, oh, he single-handedly took down the pound. No, he didn't. He's the face. He's the face of something. So it takes your eyes away from the fact that these are absolutely 100% marionette puppets. There's strings on them, and they dance whenever they want them to. And I'm just teaching you where the strings are attached and where that marionette's going to place its next foot. That's all I'm showing you. Okay. So drop down to a daily chart with this insight in mind. Man, I wish I had this stuff when I was coming up. It would have been awesome. Someone sitting out here giving it to you for free. No upsell coming. No coupon codes. No future mentorship. Buy me this. Buy me that. All right, so we are looking at a daily chart here, and you can see how prices has absolutely been stunning. Beautiful delivery. Look how many days it's been down. And then remember, we're in this inefficiency on the weekly chart, so it would be completely reasonable for it to try to make an attempt to retrace a little bit. I'm not suggesting that it should or that it has to. I'm just saying, how do I know, because I get questioned a lot, how do I know when I'm in a trade that it might start to potentially retrace against me? Not necessarily reverse, but how can I avoid having to sit through a larger retracement that I'm comfortable with? Well, you can be in partials by now. That way you have something scaled out in the event that I'm wrong, in the event that you're wrong by holding it for lower if you're short. You want to always try to find a way to fund your account consistently and not look at it as you have to have the full pull on every trade. That means from entry to target or terminus, where you think the price is ultimately going to go. In the beginning, it's unrealistic. It's unreasonable for you to anticipate and expect that you are going to be able to do that every single time. And it's not failure for you not to be able to do that. It's progress reaching towards that goal. And the amount of time that it's going to take for you to get there, you don't know how much that it's going to require of you. I don't know that, and that's why I can't tell anybody that it's going to be this much time for you to learn how to do this. Everyone's going to come to this adventure with their own problems, their own character flaws, and you have to wrestle through them. I can't fix it for you. There's no other person out there that's teaching, and I don't care if they're wildly profitable and they do live stream and they show you everything. They can't fix these things that are in us as humans. We have to subdue them ourselves. And that's going to take an unknown amount of time for each of us. For me, I had it figured out in a little less than 3.5 years, but I tinkered with it. So it took me 6 years to know exactly what I was doing. Are you willing to subscribe to an idea and a pursuit for multiple years and not feel comfortable with the consistency, but still keep doing it? If you do have that wherewithal and that tenacity, then you have the base element that's required to be a trader, because there has to be a level of tenacity that's unshakable. No matter what, you're going to stay with this. You're going to stick with it because you know it's meant for you, which is different between a gambler that just doesn't want to leave the table. There's statistical probabilities that I'm sharing and I'm teaching and proving through third-party audited settings now. Other people around the world doing the same thing. There's no excuse why you don't want to submit to time. You can learn this. You can use whatever time frame that fits your personal life. So don't think that you have to do it one specific time frame or one specific model. Every model isn't for everyone. I'm going to say that again. Every single thing that I teach isn't equipped as a perfect glove and hand type of marriage where it fits perfectly for you. It's not for everyone. So it's a wrestling match for you to decide how you're going to use the information. And I have provided complete models, step by step. Do this, do this, do this if you want to trade like this model. And I've coached, I've told my private mentorship students exactly how to use these things to plug and play. You don't need a fair value gap to be the model. You can use a mitigation block, which I don't talk very much about, but I love them. What is that? It's this candle right here. This high didn't go above this high.
I don't need it to because I'm looking for it to go where? Lower. So inside this candle here, as price is trading down, it trades down, trades through it. The next day, we're trading in it, inside this range. You can be a seller right in here, especially if it's opening, it's trading above it, you're trading in the highest portion of the power 3 on a potentially bearish day in a sell program where the market's likely to keep going lower. Where? Down here where I said it was going to go. So inside of this candle, in that range, above the opening of that day, you could be a short seller. Risk has to be above mean threshold of this candle. Why that one? Because mean threshold is just above this inefficiency here. So what do I have? 3 PD arrays. I have the previous mean threshold of this down close candle if I'm going to sell short on here using a mitigation block. And I have the mean threshold of the bearish order block. And I have the high of this old inefficiency. That's 3 PD arrays. So my stops will be behind 3 PD arrays, because if 3 PD arrays fail, next thing's my ass. And I don't want to be in a trade that has 3 things that I would suggest is helpful for the trade to be there. If 3 of them are nixed, that means they're trading through it. That means me as the operator, me, the technician, the mechanic, the person behind the decision of pressing a button, getting into a trade, that means I have done it wrong. It doesn't mean my system or methodology or my logic is flawed. It means that I have made the error. There's nothing to wrestle with. There's nothing to argue about. There's no shame in it. It's absolutely time to get out or have a stop loss in its place, so that way there's nothing to worry about. It's an objective decision that's outside my control. It's going to do its job. I'm paying for that stop to pay me at that point to get out with a limited amount of loss or whatever profit it allows me to leave with. How is that for logic? But you're all wrestling with putting a stop loss in because you don't know how to read price. You have to do the things I'm telling you to do, avoid the things I'm telling you to avoid. Focus on learning, allow yourself to journal, take these examples, go back through price action, and see if they don't repeat. And by doing that, what will happen is you'll grow in your understanding. Your stop losses that have to be wide in the beginning will start to narrow over time. You'll grow more comfortable with not expecting some wild spiky move. Oh my goodness, I'm in a trade. I just know it's going to move 80 pips against me because that would kill me. That would be the worst case scenario. And that's how you trade all the time. You think the boogeyman is going to get you every single time. I'm the boogeyman. I'm telling you what we do. This is how it's done. There's nothing for you to be afraid of. And if you take a loss, that's not being defeated. That's you using your insurance. That's it. You're paying for insurance. You're paying that stop to ensure that you will not have a catastrophic loss. That's what you want. That's exactly what you want it to do. But you're looking at it and you're teaching yourself to view a stop loss as, this is scary. I don't want this to happen. Let me do everything to avoid it by not using a stop loss. And then you wonder why you're wrecking yourself. You're blowing out your accounts. You're drawing down to a point that you can't come out of. In all manner of drawdown, it can come out of. You can come out of that. There's no drawdown that you can't come out of. It just means that you're going to have to submit to a whole lot of time. And when you see things like Steve Burns putting up things on Twitter, if you do this much drawdown, it takes you this. I don't even think about that. I don't look at those things, because when you look at things like that, it says you have to do this much to get your money back if you lose this much in drawdown. That's nonsense. Every single series of winning trades is just one incremental step forward. It doesn't matter how much drawdown you go into. It doesn't matter. In the beginning, when you're learning, all of those things are perfect learning experiences. But if you constantly feed yourself a negative diet that if I do this, this is what's going to happen. And it's always a terrible, most fearful thing for you to have. And then you wonder why you're afraid to trade with a model. You're afraid to use a stop loss. You're afraid to use realistic leverage because everybody else is telling you to do ass backwards theology. Think, folks. Think. How many times do I have to tell you something before it happens? How long does it have to happen? How many more students you have to see come forward with real results? And you have to not be selective in your hearing. When I'm teaching, and I'm telling you what to focus on and how to think about it, try to apply. It's going to be uncomfortable probably, but try very hard to try to apply it to how you study price. And that's it's a growing pain. You have to go through these things to learn what not to do and focus on the things that you've done right and cheerlead yourself. When you did it right, really pour it on thick in your journal. I'm so pleased. I'm so proud of myself that I was able to see this coming. I'm glad I did not hurt myself with this idea that if I would have looked at it this way, this would have resulted in a loss. But I didn't see it this way. I saw it this way. You're encouraging yourself. You're being your own counselor, your own best cheerleader, and you're writing the best technical analysis book in trading literature there is because it's applicable to you. Anybody else that would have their hands on it reading it wouldn't get the same thing from it. But you, when you read it, you'll be able to refer back to these milestones where you've grown in your understanding and you encouraged yourself through rough patches, and you're going to have that. There's going to be a period where you are encountering the market. And my personal students, that paid me, we had periods where I just simply didn't want to do anything. And it was uncomfortable for some of them because they're like, we paid you. You should be able to tell us. Yeah, I told you to sit still. Sit still and wait. And then when the market cleared itself up and moved out of an uncertainty, a consolidation that was not conducive for them to learn well in, I'm right back to 90 plus strike rate again. And again, my students would have came forward with proof that that wasn't true if it wasn't. All right, so let's go into, I wanted to look at Aussie dollar real quick because I mentioned, I'll just briefly look at that. All right, so right away, right under here, admittedly, I thought we would get this low taken out while I was sleeping last night. So just be mindful that there's sell side below here. So I would like to see it over the course of today and going into Friday. I'd like to see it gravitate below that. I'm not saying that that's all there is, but to me, it makes sense for it to reach down there. Bullish dollar, bearish everything else, basically. Gold, let's look at gold. Why don't you talk about gold, ICT? Because gold is a market that is very, very manipulated. Very manipulated. So can you trade it? Can I trade it? Yes. Do my students trade it? Yes. Is it something you should try to trade every single day? I don't believe so. But that's my opinion. And if you have a model, if you have an approach, or if your whole existence as a trader revolves around this, what is my opinion? Nothing. It's just my opinion. It's like assholes. Everybody has one. So if we look at this gap in here, I don't recall exactly when I said it, but obviously it's in the chart. So I know I talked about gold eventually trying to reach down into the inefficiency, which is here. So I'm going to leave it to you all to look at your notes or go back and sift through all the videos. It's been commentary since here, about in this time frame. So I guess late May, early June, from that time frame, I was talking about how we could potentially trawl down into this gap in here and take out the sell side below here. We got real close to it there. So it to me, it makes perfect sense. If dollar keeps going higher, that's going to put pressure on, I'm not saying selling pressure, but it's going to put pressure on the sentiment idea of gold wanting to be bullish. So higher dollar, that's going to allow for weaker prices in gold. They're diametrically opposed. When they're not and they move in tandem, you're in a very, very, very risky scenario. That's a decoupling. So when there's a decoupling, that means you have to be a scalper or do nothing. So we have a low here and a low here, so they're relatively equal, and you have the inefficiency that's open. And if it accelerates below this low here, we can trade down into the order block which begins at this candle's opening. So those are the levels that I'd be interesting as long as dollar is going higher. Those are the levels I'm looking for, which is below these lows here, a complete repricing of this candle's high on March 10th, and the low of this candle on March 14th, that inefficiency, which is shaded in blue. I would like to see that entirely closed and repriced to, assuming dollar's going higher still. And then if it accelerates lower, down into the order block right here. Okay, so I'm not bullish on gold.
I would not be going short. I don't want to trade it. But I know a lot of you asked me, so I've now commented and told you what I believe. What changes this? What would change my constitution of what I believe that gold may or may not do? Gold would have to go above this order block right there on a closing basis. So as long as we're not closing above September 22nd, that candle's high, which is 1929, we'll just call it 1929 and a half. As long as we don't get a closing on a daily chart above that order block, I believe that these levels here are in play for gold. And I think that's pretty clear. I'm not in it. I'm not going to trade it. But for the sake of the folks that are asking, that's the line in the sand that I believe that we're reaching for, the three of them here. And I believe that it is the icebreaker that changes the whole discussion. And I'm wrong if it goes on a closing basis above this candle's high. Okay, so as long as that's intact in price action, that's how I'm viewing gold. So that we can go forward with that. And let's go to ES real quick. This is already longer than I wanted it to be. Some of you are like, who cares? Stay on all day, ICT. I'm here. I'm here for it. I am not here for that. Let's see what time it is real quick. 9 o'clock. I got a couple minutes left, and then I have to sit with my son here. Part of his homeschooling is reading price action with me. You like that? All right, so let's go up to the weekly chart. Get through this real quick. Again, if you're learning today, if you like what you're hearing and seeing, just give it a thumbs up. It's free, doesn't cost you anything, I promise. No coupon codes are required. All right, so if you recall, as we were trading in August, I said that we were going to go up and trade into this high here for ES, and on the NASDAQ, I'll show you the same thing. There's a small little gap in here. I said we would run that, and then I said, thinking in terms of a quarterly shift, that means the next 2 to 3 months, what am I expecting? Because everybody likes to think that I cherry pick things and delete things that weren't accurate. That's not the case. I never delete anything. The idea of a quarterly shift is absolutely unavoidable in terms of whether I'm right or wrong. So I said that we would go up to go down. Did we take out that high? No. We traded just inside this inefficiency right there. Then what? I said the quarterly shift I'm expecting, I want to see, as we see price trading into October, November, I think that's as verbatim as I can get. I know I said going into October, but my students in my core content lessons teach you this. So it's a matter of listening to what I taught. I'm putting it into practice. I did the analysis on YouTube. It was in live stream. It was in recorded sessions that are time and date stamped. You can't escape it. It's there. And here we are. We're trading inside that inefficiency down here. I mentioned that inside this inefficiency, between this weekly low candle coming in at 43.52 and a half, and this candle here on May 22nd of 2023, I have it drawn down to this body. And the reason why I did that, and I explained it, I don't know if it was in a Twitter commentary video or if I've done something on a recording on YouTube. I'll leave it to you. And if you know which one I'm referring to, where I talked about how I'm just going to draw it down to this area because it takes into account the volume imbalance that's here. Like if I take this off for a second, right away your eye should snap right to that as a volume imbalance. So usually you would see me do this. Like that's the volume imbalance. And look where it stopped. Consequent encroachment. Because there's no bodies there. There's no balanced price range. There's no order block. So the midpoint is what? Consequent encroachment. So let's test the theory. From body to body. What's the price here? 43.07 and a quarter. What is the low here? 43.05 and a half. And we're looking at a weekly chart. Now, if you were using analysis concepts on a weekly chart,
and you were wanting to see if there was something that's measurable in terms of precision, if there's a rhyme and reason behind why price should do something, that should be a very good selling point, that what I'm teaching you on a higher grade time frame, like weekly charts. Like there's a whole lot of price action, a whole lot of randomness, a whole lot of buying and selling pressure going on. Of course, I'm saying that facetiously, but that's pretty tight. No matter how you slice it, where you come from, what school of thought, that's a pretty good estimation for where a realistic draw on liquidity should be. Because if you think that it's only going down here to go higher, I don't subscribe to that view. I believe that we might want to get into this a little bit more and reprice to the entire close of that. That's what I'm willing to subscribe to going into October. I don't think we've hit the low yet. I don't think we've seen capitulation. I don't think that we're bullish longer term. We're going into the harder times for the marketplace, in my opinion. But this is what the volume imbalance would look like if it was there in the chart. But because it was not, and I had shown you this, I incorporated the entire scope of the range between what would otherwise be drawn like this. That would be a fair value gap in the form of a buy side imbalance, sell side inefficiency. But because we have this volume imbalance, that's why I said I would draw it to here. So that encapsulates all of it. So it kind of like gives you a little bit more detail. But here we are, we're trading down here. Go back and watch the August commentaries where I said it was going to go up here, and then the quarterly shift is coming, drawing down into there. So how many handles is that? 300-ish. And on the S&P, by the way, that's a significant price run. Let's go into the daily chart. I say this stuff to remind you and to have a emotional experience by helping you remember that these things were said to you beforehand. That's not bragging. I know how to brag. This is not bragging. It's to make you understand that these things were shared to you and with you real time in a capacity that can't be faked. So the market ran up in here, took out the high, broke, lower, traded higher, inefficiency, bearish order block right there. Price breaks. We want to see what? We want to see proof that it wants to go lower. What would that look like? A breakaway gap right there. Did that fill in? Did this fill in? Did it even reprice to it? No. So this is a good signature to have to anticipate that we're really strongly in contention to run these lows out here. And we did so. Come back up, trade into this low. Why does this low, for the classic support resistance, guys? Because now you're thinking, oh, well, he's making this complicated because all I would do is sell short here. Okay, show me you entered short there. If you know that this is how it works, for the folks that come to me in my comment section and saying it's this and it's that, show me your trade entry on that stuff. You only talk about it after it happens. I'm talking about before it happens. And then I'm trading with real money on it. Hello. Why is this low now supposedly support after support broken now becomes resistance? That's the theory, right? That's what everybody learns in the books. Why did it work right here? Why did that happen? It has nothing to do with this low. What's over here? Study that. Everything in here gives you this and that. Price runs down, falls short of what? The imbalance on the weekly chart that you can't see here. Can't see it in here. Remember, this is the range that's drawn on the weekly chart. This. That's this right here. So if we go back to the daily, if we wanted to do the inefficiency on this time frame, it would start with here, there, and utilizing the order block. But we have what showing on that? We have a close below it. Meaning, and I take that as, okay, it might want to reprice up into what's already been delivered, which is this down close candle, and then we have what next to it right there? A wick. So inside of this wick, there's halfway, which is consequent encroachment. So I would have that level on your chart. I'm not going to do it because I don't want to spend time doing it. I'm going to get through it, but I just want to tell you where they are. You want to have that level on your chart because it might, and it could very easily reach up into that and make everybody think that the low is in place, and then just use that as a reason to trade lower. I'd like to, personally, I would like to see it not trade there, because the fact that it's not trading there makes it a PD array as well. Because it would be treated the same way I would view like this breakaway gap up here. A PD array that's not traded to, what I am allowing for, and my algorithm allows for it to trade to it normally. If it doesn't do that, the information and the insight that it gives is that means that I am absolutely bearish. That means that the market's really bearish if it can't trade up into consequent encroachment that wick. But if it does, it would need to do what? It would need to completely smash the shit out of it and keep it from going any higher. Because if this gives up the ghost, think about what we have. We have mean threshold of this down close candle, which I'll do it here for the sake of completion. We have half of that range, which is 4343.75. Then we have the range of that inefficiency on the weekly chart, or not a weekly chart, on here. You want precision. These are the things you got to do, folks. This is too much. This is complication. Okay. Trade with mediocrity. Then you have mean threshold here. So right away we have an agreement that there's two PD arrays saying that this is reasonable to trade to. But can it go beyond that and just like a mohawk or stab up there and still remain bearish? What would we have to contend with? It would be this. Not that. It's this. Why do I keep grabbing that? Good grief. ICT, if you would have just paid attention, you were grabbing the wrong thing. I know. Armchair quarterbacks. So 4351.75. Okay, so in my mind, it's perfectly acceptable. It's permissible. It's reasonable. It would not change the bearish tone that the market has. It can trade that much higher today, tomorrow, Friday, into next week, and still be bearish for me. Now, if we get a daily close above that 43.51 and 3/4, that's problematic. Because why? That's 3 PD arrays that it's now going through. Oh, light bulbs are coming on, aren't they? But this is not even a weekly chart. So if you would have did this, there's nothing wrong with that. Absolutely nothing wrong with it. But you can't just simply just use that when you have a real volume imbalance down here. There's a link between this candle and this candle only by the basis of its wick. See that? This little wick here. So you have to encapsulate that too, just like I mentioned on the weekly chart. So if there's ever a gap or an inefficiency like a volume imbalance within a buy side or sell side imbalance or fair value gap, you have to incorporate the entirety of that because it's going to be meaningful, it's going to be impactful. As you can see, it's even went a little bit outside there. And then this order block here, you can use the last down close up. I'm sorry, the last down close candle prior to it moving higher. That is the change in the state of delivery, that candle's opening price. So you can incorporate that as well. So those are the key levels I would have for ES. And I'm not changing my stance on it. I believe we're going lower still. And I just told you exactly what would change my mind about being bearish. Okay, it would have to close on the daily chart above the mean threshold, consequent encroachment of that candlestick's tail or wick under the body of it. And now we can move over to NASDAQ. Finally made it. We finally made it here. Weekly chart. I got a couple minutes. I can do it. I can do it. All right, so here is the same application of what I was referring to through this lecture for using inefficiencies and mapping them on your chart. If you have a volume imbalance that's
part of what would be the candles that make the buy sign balance, sell sign efficiency, in this case here, the fair value gap with an up close, which is a BISI. You can't ignore the volume imbalance. You have to include that. If you really want to see the total scope of the inefficiency, that's how you would do it. You don't want to just do it this way because you're not making or taking into account that could trade down there too. Okay, so that's why it's there. And we have seen it trade down into the volume imbalance here and consequent encroachment of this wick. See that? So we went below here for sell side. It's perfectly reasonable for it to trade above this candle's high and trade into this portion here. I would not want to see a close above the volume imbalance that's right there. As long as we don't close above the volume imbalance right here, I'm bearish long term. That changes the whole setting for me. But it can trade all the way up and it can touch. It can trade into it, but it cannot close above that. If it closes above that, I am not bearish. Doesn't mean I'm going long, but it doesn't mean anything but I've abandoned bearishness because I think that ultimately we're going to see before Thanksgiving that's where I think NASDAQ's going to be before Turkey Day. Barring any run on a closing basis here above that weekly volume imbalance. Okay. Why am I picking that? Because we have this week's high. That's a PD array. We have, you guys are really learning some stuff today. I really expect to see some measure of thumbs up on this because it discourages me that you're willing to sit through this stuff for free. I'm not charging you anything. I got my son literally waiting here next to me, looking at me like, are we going to be doing anything or I'm just going to watch this? Like I have other things I could be doing. And I'm asking for the simplest little currency, which is a thumbs up. It'll help you find this video also because it'll be in your liked videos. Here's another thing. You can create a YouTube channel as a student of mine and like certain things, and it'll allow you to go to those very videos to have those certain things that you want to revisit. Like these are really good lessons. Like these are things that my private students don't even know this. Like I'm teaching this just like you're learning it for the first time. They're learning it with you. So there's no mentorship being done, okay, where there's videos being done. I'm not giving signals. I'm not doing videos for a group of private people. I'm literally teaching you for free, openly, publicly, because I'm making it unprofitable for people to try to sell my stuff. They can come here and get it for free. But with all that said, we have this present week's high. So if we trade above that, that's one PD array that I'm willing to accept on the weekly chart. Because I'm framing my bearishness on the weekly chart. Where's the other two PD arrays? Well, mean threshold, consequent encroachment of oops, yeah, I had it right. If we have this low that's formed on this candle's high or the present weekly high and this candle's high of September 11th, this is being treated as what? Last week is being treated as a fair value gap in the form of a sell side imbalance, buy side inefficiency. That means it's a SIBI. Okay, down close fair value gaps are SIBIs. Up close candles that are fair value gaps are BISIs. I'm accepting the fact that it can trade above this week's high. It doesn't change long-term bearishness for me. I'm accepting the fact that it could trade all the way back up to consequent encroachment of this candle's inefficiency, which is what? My old eyes here. 15,156 and a quarter. Is that right? Eyes are failing me. I apologize. And then you have the volume imbalance here. So there's three PD arrays that kills it for me. If we have a closing price on a daily chart, we're looking at a weekly, but if it closes above this volume imbalance on a weekly chart, I have aborted the idea that this is where I believe it's going. Until this occurs, if it closes, and I don't believe it will do this, I'm tipping my hand, I'm showing you that this is what kills it for me, and no longer am I bearish on NASDAQ to this degree where I believe it's going to go down here by Thanksgiving. So I'm giving you a time horizon, a time target, an actual price target, and what makes me wrong where I am no longer subscribing to the view that we're bearish. That, my friends, is the complete analysis where it tells you where I believe as the operator of using this information that this is where I believe I'm wrong. This is where I'm wrong in the interpretation. This is where I'm wrong as the trader. This is where I'm wrong as the analyst. So I'm speaking to you today in the role of the analyst in ICT, where usually you get the trader and the wild guy on Twitter Spaces. You're hearing the analyst today. I'm showing you, pulling the veil back, and I'm telling you what makes me feel that it's bearish and what would change that. These are all the questions that you're trying to figure out on your own. And until you look at it like this, there has to be 3 levels that would otherwise be completely acceptable, reasonable retracement points. But if 3 of them fail, that's a definite, we're done. It's three PD arrays, then your ass is next. That's it. That's the way you remember it. That's how I internalize it. That means if the 3 things that I would reasonably expect to see price perform in a function of, in this case, resistance, it should stop price. It should keep price at bay from wanting to go higher. But if it signals a close above that volume imbalance, that's what smart money is going to see as, okay, we're no longer moving sideways. I'm sorry, we're no longer moving lower. We may move sideways and then wait for more information. And if there's a displacement to the upside, then that tells smart money, okay, wait for the reset, the reprice lower. That's not buying and selling pressure. It's literally, that's how they signal to one another. That's just the way it is, folks. I don't care if you believe me. I don't care. I don't care. I'm the one out here telling you before it happens. So if you go into a daily chart, okay, and you don't see the volume imbalance the same way on the weekly chart here, but we end up getting one right there. That's convenient, isn't it? So right away, that is a double whammy. It's like, pay attention to me. Pay attention to me. If we never trade back up there, that's wonderful because that acts as what? What does that act as? A gap. A gap that's not retraded to or repriced to is a significant mile marker in a price run. We have a breakaway gap like up in S&P. We have a gap here in the form of this volume imbalance if it never trades there. And we also have another gap there. It never even was interested. We have one here. Did price get up into it? Nope. Price broke lower. We're below this low. So now because we tapped into and engaged a pool of liquidity on a higher time frame, weekly and daily time frame, which is below here, all those orders, they've been engaged right there. Now we have to wait. Does it need to? Does it need to come back up above here? I think personally, it should not even go above this level here. I don't think it needs to do that. And if I'm watching the daily chart, I'm going to be a whole lot more sensitive to not taking shorts if we get above here. Even though I've given you this context on the weekly chart, on the daily chart, I don't think that the structure and price right here is allowing for any need for price to get up there. So I'm saying basically that I would like to see the mean, well not the mean, the consequent encroachment of this candlestick's tail or the wick below its body. I'd like to see it stay below that. And if I get that and we trade to it or refuse to trade to it and just break lower today and then tomorrow going into Friday, we're really, really bearish. So it gives you a lot of context in terms of the magnitude of the move that's potentially unfolding. So this is all part of reading price and reading the tape, getting the details of what should be allowed for in price. But if it doesn't even have an interest in returning to those levels, that is extremely powerful for being on side in your trades. You don't get that stuff in books. You don't get that stuff from all the retail logic. It's a lot of things that have to be weighed out, and it's not easy. I never claimed it was going to be easy, but I said I would make it easier by showing you the things that I think about in terms of my internal dialogue and what has been used and codified in my algorithm. So
I think we did it. 927. Lower prices in order. Um, Turkey Day, Thanksgiving. By then, that's what I want. I want down there. If it takes a week after that into December, who cares? I didn't see that as a failure. I'm bearish. I'm going to be looking for shorts. I'm going to continuously make money going short with real money account. I'm literally going to beat the shit out of it. I'm showing you examples of it. I'm zooming in where you guys like to ignore when it's down here. You're saying it's a demo account. Go down here and look in those recorded executions. It says live. Okay. I don't even know if AMP has a demo account. I've never even looked at it. But if it does, hook it up to TradingView and see if it says AMP live down there for a demo. Bet you $1,000. Bet you $10,000 it doesn't do it. How's that? I haven't even looked. I'm willing to bet that. But until I talk to you next time, I'm going to go head over to watch a live streamer and see what's going on there. And then I'll share anything that I do or what I teach my son in the process later today on Twitter. Have yourself a very wonderful day. Be safe. Until I talk to you next time. Good luck, good trading.